Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. Now, you might notice something a little bit different today. I am at home. I'm quarantining myself. I've been a bit ill over the last couple of days, but the show must go on. So I'm here with Ever and Costa. It's kind of a weird experience for me today. I feel like I'm in the studio, but I'm not in the studio. Guys, how are you? How's your weekend been?
We're good. We're glad you stayed home. We don't want to...
Yeah, I don't really want to get sick. But it feels a bit weird seeing you on a computer screen, but it's good. We were able to still do the podcast, so I'm happy about that.
Well, I apologise for my appearance and maybe my slow brain today, but let's see how we go. So obviously, we always like to start looking at the clearance rates. And what used to be a shocking story is kind of becoming the norm, guys. So combined total clearance rate has held below 50% for the third consecutive week. I remember it happened the first time, we're like, oh my God, but it just keeps going. And obviously each time there used to be something that we say, well, there's bank holiday, or well, there's this. As of this time, no, it's just staying lower. There's obviously a variety of reasons that we've covered before, but let's run through a few of the headlines. So the last week's early result increased slightly to 49.8%, up from 49.2%, basically the same. Across the capital cities, 1,447 homes were taken to auction, 17.2% fewer than the previous week and 19.3% below the same time last year. So obviously we're seeing a little bit lower there. And obviously last week I think we talked about how house prices are kind of not nosediving at all, but kind of nosing down, let's say, for the time being. Guys, how have you noticed this amongst your clients? Are they cautious, hesitant, seeing it as the right time? What's going on?
Yeah, there's two things from what I see is one, people that were looking to sell are actually not going to sell anymore and holding until, I guess, this passes like everything else. And there's also buyers thinking, well, I might wait as well a little bit and pick up a bigger bargain later on. And then those who have put their house for sale, I've seen a few restoring as well. Mm-hmm. When you do have a choice into selling your home, you don't want to take a big cut and big discount and
they probably don't want to take a big discount, because if you're selling your house as well, there's probably something else that you're doing with that money. And if you're not getting that money that you require, you can't purchase the next one or do whatever they need to do. So it's all wrapped into one. Back to what I ever was saying, I think a lot of people are holding out to sell. I've had a couple of clients that part of their strategy was to sell an asset to free up some money to purchase some more property. They've now pulled back and just said, let's see what happens over the next 2, 3, 4 months. Yeah, and the auction clearance rates, it's at 49, but they usually get revised down from about Tuesday to Wednesday. So that's probably going to go below 45% by the time we hit tomorrow. I think that's just going to become the norm now.
It's going to be interesting with spring coming up.
I was going to say spring, you would hope that it's going to jump up a little bit.
Well, I don't know. There's going to be so much more properties for sale. Like that's what we normally see, that it drops even more because people don't buy. I don't know. Let's see.
Yeah.
Let's hope. I feel that we are slowly seeing the first kind of, at first it was more the predictive effects of the budget, as with now we're going to start seeing the actual effects. And obviously
rates as well,
we've had some,
they've been high.
Some unhelpful inflation readings, which means that rates hikes are definitely back on the table. Rate cuts are certainly not on the table.
That's right.
So these all feed into reasons. What about on the investor side right now? As you said, let's unpack SMSF in a second. But in terms of the investor market, obviously the dust is kind of settling. They're kind of looking at their strategies. They're looking at what they can do next. How are they feeling and where are they going amongst your clients at least?
Well, what I see, even for myself, is a bit of like, okay, hold on, let's see what is actually possible to do. Not so much with the budget and what we are allowed to do, but also how we're going to make it work lending-wise. Because regardless if you want to buy a property, 2 properties, be a portfolio investors, if you cannot get the lending, you're not going to go anywhere. There is still a bit of uncertainty as to what banks and lenders are going to do, when they're going to do it. Things are changing daily, so it's a little bit it's a little bit tricky to make big decision into, let's buy this property when you don't really know what's going to happen with your finance.
Yeah, that is a really difficult kind of aspect. So the uncertainty is still ruling. I remember the MFAA saying something really similar. Where they were saying,
talk about uncertainty. St. George and Westpac were accepting negative gearing up until about a week ago.
yeah,
and then they just cut it and they just said, well, the applications don't work anymore. You're going to have to just go back, refresh it. Or if you want to keep negative gearing, you've got to have to purchase a new property. So back to what Eva was saying, it is changing rapidly. There are still a few lenders that accept negative gearing. But again, they can tell you tomorrow that they're no longer accepting it. So that application is gone. So
yeah, I remember that their email to begin with was incredibly ambiguous. It was basically like, we'll see, which is an interesting. What are the non-banks doing right now? Are they in a similar basket that they're saying we'll see, or are they saying
there's
that
a bit
they're
of
going to
everything?
leave?
Some have stopped already. Some are still officially taking negative gearing or using negative gearing in their servicing calculator. But when you actually pick up the phone and call BDMs, what we get is, yes, as of today, we are accepting negative gearing. Tomorrow, if your file is not formally approved and we change our mind,
it's gone.
It's gone.
Yeah.
So it's quite tricky to, I think for investors to make decision, put a deposit down, start the build and pest inspection and everything you got to do, knowing that you might not be able to get finance. And if you were about to do this with a major bank and that doesn't work out, you're then going to have to go potentially with a second or third tier lender with rates are a lot higher. People just decide, well, actually, that I can't actually afford that without negative gearing.
That and does the number stack up anymore?
That's right. It can't service.
Yeah.
So at the moment, it's a bit of a let's see what's happening and what we can do. Very very tricky time.
But guys, another thing that I saw that was really interesting on the investor side. Well, something that really surprised me actually was some new analysis from Catality. I think you might have seen this as well. They looked at 3,000 different suburbs across Australia and found that, against what I would have personally predicted, I found that owner-occupied areas delivered stronger long-term capital growth than investor-heavy suburbs. This is between 2010 and 2026. Units were the biggest gap. So owner-occupied dominated suburbs for units increased 99% in value compared in that time frame, 2010 to 2026. Compared with 65% in investor-heavy areas. That's around 148 grand. Houses also outperformed 136% in owner-occupied versus 117, so a bit smaller there. That's such an interesting stat to me, and I want to your brains as to where you see. Is that surprising to you as well?
Yes, I think that's a long-term analysis, right? 2010 to 26.
Yeah.
16 years worth of growth. Doesn't surprise me for units, but the house part, which is how much? 19% more. That's a lot. 19%.
Yeah.
Yep. I think it comes from a few things. Obviously, owner-occupier suburbs have more scarcity around houses and even units, and they're more like smaller blocks and things like townhouses. I guess if you buy in an owner-occupier suburb, they are owner-occupier, they will hold their property a lot longer, which means there's less property on the market. People will fight to buy that property. And three, if it's your home, you're more likely to inject a bit of cash to renovate it, have an extension, structural renovation, and actually make it a better place to live in. So obviously that increased value. That's what comes to mind when I think about it. That says many of our investors do not buy into those suburbs and are still doing very well. And for two reasons. It's too expensive most of the time and you can't build portfolio. Most people wouldn't build portfolio buying properties that are worth like 1.2 million. Yeah. Most of them buy the 6 to 900.
Yeah, no, when it comes to the units, I was a bit surprised, but when it came to the houses, not so much, because just out of my personal experience, when we purchased our house, which is in a very heavy owner-occupier suburb, I paid overs. And I'm just like, I'll figure it out later, because I really wanted the house. Now that house has been knocked down and it's been rebuilt, so we've increased the value of it. So when emotion starts playing into the purchase, that's when you're willing to pay a little bit more. We paid a bit more. And then, when we're purchasing an investment property or someone's purchasing an investment property, the numbers have to make sense, because if they're not, well, you're going to have to fund this for 2 extra years, 3 extra years, and does it actually really make sense to do that? Do you just then go to another suburb and then purchase that property? So I think the emotion just comes into play when it comes to houses, because it's like, I guess, your forever home. And then, you're going to do renovations to it, like you said before, new kitchen, new bathroom, knock it down, rebuild. So it increases the value of those houses in those suburbs. So, yeah.
Yeah, absolutely. And you see that in those kind of really high value suburbs. You walk around some of the harbour and you see that people are knocking down the entire thing.
Yep.
That might not be, sensible from an investor's perspective, but if you have
unless you're subdividing and building multiple houses and selling them off, maybe that's a good one. But
definitely
and I guess with the
value injection there from the fact that it's your home and emotion. Yeah, there's definitely. And then if it's an investment property, I find like, well, if you miss out, well, there's always next door that might be for sale, and you don't really care. Most investors don't even see the property they're buying. It just a numbers game.
It is, yeah.
So surprising, yes, the percentage is a lot higher than I thought, but deep down it makes sense.
Yeah, it'll be interesting to see where this goes next, because obviously the suburbs that were performing particularly well in the last kind of decade may not be the ones that perform well this decade, as we see, the kind of shifting in momentum across Sydney, but also across the whole of regional Australia, as well as the capitals, is kind of changing. I did a piece just yesterday about Western Sydney and about the kind of gains that are being made there. And obviously, when we see that, I remember talking to you guys about the way that you've seen Sydney. They say, the Sydney house price is going down. When you look at the map, it's actually a very different story, right? Yeah. Some areas of Sydney are actually doing really well, while others are, are seeing a bit of a dip in price. So that's really interesting.
Yeah, I found the negative gearing removal as well might reshape the market in some way, where investors actually will have to, if they really want to invest, go into those new builds. Yeah. And might have to find themselves in a more...
well, I've got a client that has accepted that he wants to buy a brand new build, so he wants to keep negative gearing. So he was the first one. So
we haven't seen
there is a shift. Listen, it's one of many of clients that I have, but I'm sure there will be more.
But the decision was based purely on negative gearing.
Yeah, it was.
So that's going to happen.
Wow.
We're going to have...
So it's behavior, yeah. Obviously to a minor extent rather than a major extent right now. Yep. Guys, we've got to take a quick break there. Back in a sec to talk about SMSF. Welcome back, Broker Daily Uncut. Now, before the break, obviously we were talking about investors, where they're going versus owner-occupiers. But there's another part of the market that obviously is changing an awful lot at the moment, which is, of course, SMSF. Changing or being removed entirely, we shall see. We did a bit on how it may impact kind of commercial property, how it may impact investor activity around there, particularly around business owners. But Finance Brokers Association of Australia, FBAA, their CEO, Leo Gajic, said that brokers must accept a new world created by the ban on residential SMSF borrowing, I should say. But you guys have noticed something very different, haven't you? Which is that obviously we have this 45-day kind of grace period past the royal assent of the bill where SMSF borrowing can continue. What's it been like in this time?
It's been very busy. We've had a record week last week. I don't think we've ever lost that many SMSF. Massive. So there's definitely FOMO going on with everybody, and everyone they know wants to get into SMSF as soon as possible. It's less than a month away now, but
I think it's about 4 weeks.
Yeah, so it's the 10th of August that's finished, but it actually is on a weekend, so it's really the 7th of August, really the last day you can sign a contract. So you got a month from today, right? That's a very short time.
How does that work?
The contract needs to be dated before the 10th of August.
Yeah.
So the contract date
is that doable?
Well, you can sign a contract.
You can sign a contract today without funding. It's a big risk. I don't recommend it.
Yeah.
But people out there will probably do it.
I think the big risk that comes now is if you already have an SMSF and everything is created, like you've got a SMSF deed, you've got your trustees, you've got your rollover done, and you were about to buy an SMSF property anyway, a month is plenty of time.
Yes.
The issue is we have people that have pretty much never really heard of SMSF before 2 weeks ago and suddenly realize, well, actually this is my time to do it, or it's finished for me. So people going in, creating SMSF and buying SMSF properly within that very short time frame, which it's still possible. It's just really hard, and then that cuts, I think, a lot of corners. I think most of the time people would use a financial planner to make sure that's a good idea for them. They would go and see their accountant. They would go and make sure with a broker first that they would service. That's all out of the window. People call the broker first. They skip the financial planner. We actually don't really need it. We want to do it anyway. The accountant just set up everything very quickly. Knowing that, the ATO might take up to 28 days to release an ABN number, and that's pretty much your time. So,
well, even just getting your funds over from your industry super fund, that can take anywhere from literally a week to 1 month
or more.
Or more, yeah, as we know. So, I think if you're planning to sort of execute something this week to begin the setup, you're running a very, very tight rope. And I've been informing people going, I had a meeting yesterday going, you've got nothing set up. You do know this all may be for nothing. But they're just like, I want to put my hat in the ring and I'm willing to lose, the $5,000 for the setup and whatnot, but at least it gives me the opportunity to purchase. And again, we don't advise on that. That's up to them and their accountant or financial planner. But we just got to tell them, it's razor thin at the moment because it's 4 weeks.
It's not hard to set up an SMSF and go for it. It just takes time.
Like I said, it's the ATO and the cash coming in.
There's a lot of third parties involved. If one of them does not play the game, it's gone. We can set up, we can do a pre-approval in 2 days. That's easy. But if we don't have the SMSF deeds that comes through, if the ATO doesn't come through, if the rollover doesn't come through, if your buyer's agent doesn't find a property...
Calculations are easy. It's just what you get from your employer plus the rental income. It's easy on our end. It's everyone else that needs to run.
What's the kind of, if there is one, what's the profile of people that are coming to you now? Are they investors? Are they people who have been thinking about SMSF for a very long time but chose not to, and this has kind of been the cast? Like, is there a kind of profile, or is it a real mixed bag of people that are kind of trying to move in?
I think it's a bit of everything, all of the above. Probably say, more than 50% are current investors who were always going to purchase in their SMSF. But it was like, let me cap myself out in my personal name, then I'll venture out to SMSF. But that's just sort of made them act quicker. And then you do have, a good 20, 30% that have never had an SMSF and just basically heard about it and just go, you know what, like it's something I've heard about, haven't properly investigated, but I want to do it. So they're looking to do it.
I think there's a cohort of people that knew their balance wasn't that healthy to buy a property that was worth buying. But because the option of building it up for another year or so is gone,
it's gone.
They are reducing, I guess, their goals. Like, well, we're not going to buy an established property. Maybe we buy a unit for a bit less money, and at least it's something.
Yeah, and that's the mentality.
So
of people
reducing their goal there a little bit.
Yeah. What about the other opportunities that remain? Obviously, maybe it's too early to talk about them, given that we're still in this kind of 45-day period. Obviously, there's potential for refinancing. There's obviously increased demand. I was talking to a broker about the potential for increased demand for commercial property acquisitions, particularly for self-employed borrowers. Obviously, it's a minefield about how you kind of can lease yourself a property through SMSF, but it is definitely an avenue that I think some people will explore. Are those kind of things on the table for some clients, or is it still very much let's just see how this kind of pans out?
For self-employed people, buying their place of business through SMSF always made sense.
That's been very common,
that's not new. Maybe more people will do it if that's the way, or one of the only way they can invest in properties through SMSF. That's definitely going to be probably a bit of an increase there. And then I reckon people that wanted to buy residential will turn towards commercial. We'll see an increase into commercial buyers agent.
Yeah,
and that's what's going to happen in SMSF for sure, which actually defies the purpose of making it a bit safer in SMSF, because commercial property can be really tricky to navigate for people that don't really have
know. Yeah, and especially commercial, when you start getting into that space, it is different, and it's not the same as residential purchasing and structures and leases and stuff like that. It is very different, and it's a space where
liquidity is important.
Yeah, if you you may not have a tenant for 6 months, and then in that 6 months you have to fund it out of your pocket ultimately. Whereas to a residential unit or a townhouse or villa, the chances are that it will get leased pretty quickly. Let's say 2 months max in a worst case scenario. Whereas to a commercial can sit there for 6 months, it's not uncommon. So it's a space that if you're going to get into it, make sure that you've done your homework, because it's not easy and the risks are higher. I guess that's why the yields are higher, because the risk is higher. But if you don't know what you're doing, I don't recommend getting into it.
Yeah, it's a difficult kind of sector, and obviously you might see more people getting in, as Eva just said there. Guys, we better take a quick break just there, and after the break we'll come back, talk a bit about Help to Buy. See you in a sec. Welcome back, Broker Daily Uncut. Now I want to ask you guys before we finish about Help to Buy, because we reported this week that Help to Buy has expanded again with an extra 10,000 places. This is the federal government's Help to Buy scheme. Obviously some of the states have slightly smaller, different ones. But it's added 10,000 spots, increasing income eligibility thresholds as well from the 1st of July 26. So eligible buyers in this scheme can purchase a home with a 2% deposit, with the government contributing up to 40% of the purchase price for a new home, or 30% for an existing home. Income caps have also been increased to $103,000 for single applicants, $165,000 for single parents and joint applicants, while the property price caps changed. Guys, I know that this is, in the grand scheme of things, a smaller scheme than, let's say, the 5% deposit scheme, which often gets a lot of the limelight. But what do you guys think of the scheme? Have you guys had people talk to you about it? And where do you think it kind of fits in like the overall kind of housing, schemes that the government offers?
I've never written one, if I'm going to be honest with you. I don't think the conversation has even come up about it.
Well, only Bank Australia for the broker channel, so it's quite a limited scheme right now. Yeah.
I would imagine.
It's not our client base really.
Yeah.
This type of application. I think is great for second chances in general.
Yeah.
Single parent, divorced people that just maybe ended up late in life with not much. It is actually available to people that have not owned in the last 10 years. So it's not like first time only. That does help. And look, 2% is doable.
Yeah. Well, my only sort of concerns,
they said in there.
Sorry, I was going to say my only concerns with this is because it is 2%. Like if you were to purchase something in January, there's a good chance that 2% has been eaten up, and you're basically in negative equity now. So that's an issue. And I would say, just based on the government opening up 10,000 new places, that it is getting more and more popular. So they've seen that through whatever data that the government is going off. And what have we got here? 7,200 since December 25. That's 1,200 per month. So it is increasing. I think we spoke about it earlier in the year where it wasn't that many, but now it just seems to get more and more popular. And I guess with an extra 10,000 places that the government sees that as well.
Yeah, I think the main also, fact there is that they've increased the income cap, which I think shows how much, like you think, okay, if you're earning 100 grand, which is like the median income roughly in Australia, you would be okay to maybe get 5%. But clearly people aren't okay to do that. That's why they had to somehow increase it. So I think that says something, that the market's really gone out of reach from the median person.
Yeah, no, I probably agree with that.
Yeah, and obviously it impacts the way that, you know, who it's kind of targeting is quite specific, it seems, obviously with the 5% deposit scheme there. In the past,
We've lost you, Julian. We've lost the last 10 seconds.
Are you back? Am I back now?
No.
Yeah, I can hear you. But the screen.
Yes.
Yeah, gotcha.
Are you okay?
You're back.
So obviously within that, you've got the 5% deposit scheme, which obviously targets a larger cohort. But in the past, I've kind of talked about these shared equity schemes where the government is literally, you know, owning a part of your property, and the kind of implications around that, about, you know, how does that work when you want to refinance or change lender or move on with your life or sell? And obviously there is a huge kind of just, I wouldn't say issue, but something that definitely buyers need to consider there. Is that something that you thought about there?
Well, this is the issue of negative equity right now, where prices have dropped a little bit. So if you only had 2%, it's very likely you're actually on nothing of your property, and you're still paying obviously a mortgage. So that's the one thing. Secondly, as you said, only Bank of Australia and CBA are doing it. So the option to refinance on there, if the rates go up, you're pretty much stuck with who you are there. And if you sell in, you know, even though the property might have gone up for, I don't know, 5-10%, you know, I think people are going to lose or forget that they're not owning the whole property.
Yeah. You're basically in a shed, obviously.
Shed, yeah.
Yeah. Yeah, you basically own it with a silent partner, let's say.
Also stops you from investing any further.
Yeah.
Yep.
Like those people doing this, if they had any plan to invest using equity, that's not happening.
But I would imagine someone doing this probably isn't the profile of what an investor is. And
they can always become. They can always become.
Yeah, I know. I was going to say, in the end, that they can always become investors, 100%. But I guess they'll have to sort of get out of this loan agreement with the bank. Well, sorry, not with the bank, with the government before they can do so.
Yeah, no one knows how hard that's going to be. It hasn't been done yet.
Well, yeah.
You don't know how.
That's the tough. Yeah, particularly if your house price grows, or there's kind of the differences there. You've got to pay off the government before you can kind of move on. And also, as I said, like, how do you, these days, you know, the idea of refinancing with other lenders and making sure that your loan is competitive. How does that work there? I mean, there's lots of different questions around it, which are interesting. But, you know, it clearly there is demand for it, and clearly, you know, and also I think it's an interesting point of kind of who's going for it. So you go through first home buyers account for 86% of participants, while 70% are single applicants. Median deposit under the scheme is 30 grand, with older single women emerging as a significant beneficiary, accounting for 42% of female participants aged 40 and over. So I guess the ends is that you're seeing a much wider set of people, a much wider cohort of Australians owning homes, which, you know,
I think this is really for people that otherwise would have never been able to get in. I think you mentioned earlier, Julian, that it gets sometimes a bit cheeky when we see like with the first 5% first home buyer schemes where people actually with very high income are actually using it, right? So I think there should be maybe a bit more regulation and checks around who's doing what and accessing it. Obviously, you know, especially when there's spots that are you know, allocated to people. You don't want someone that actually could be doing really well. That just takes a spot of someone that really would be struggling to get the 2%. And it's I think it lose sometimes to.
Yeah, you need rules and regulations around it. Otherwise, anyone and everyone just will take advantage of it, and people that actually need it will lose out to people that really don't need it at all.
Yeah, well, I guess these schemes, where there is, you know, a finite amount of places, they are kind of more rigorously checked. The thing I believe about 5% deposit right now is that there is no cap.
There's no cap.
So
That's
I guess that is why you're seeing it.
Yeah, I know. But you'd think, well,
Yeah, you're seeing a wide.
You know, if combined you're on $400,000-500,000, well, why don't you have more than 5% deposit?
like one thing we
If it's
do.
there, why tie up? Why tie up? Yeah, why don't you?
Yeah, we do have like this know your
Yeah, it's
customer.
Guys.
I guess Julian, it's not, we have to know why. Like if someone is on, I don't know, 300 grand combined, why couldn't you put 5% together? Like that says a story of people, like where are they spending their money on? So no income cap, yeah, it's good, but that could open the doors to, to different things that might not have been, wanting to happen by the government. So let's see.
Yes, absolutely. It's a minefield politically and financially. But anyway, let's end there, guys. Thank you so much for joining me. If people want to hear a little bit more about Finni, I always ask you guys at the end of the show, where can they go?
You can go to finni.com.au. There's a number there as well that you can call us on. You can email us. Lots of way to get in touch with us.
Well, guys, Eva, Costa, thank you as always. From the comfort of my own home, I've managed to have a really interesting. So thank you very much. We'll be back as normal, I hope, next week. And for everyone listening, enjoy your week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.